What a way to end the week. A
Good
huge
day.
rally here, especially in light of a very weak jobs number. Let's break down this week's action. Tom Lydon, ETF Trends editor, telling us the best ways to play this volatility. And Jeff Sott, Raymond James chief investment strategist, telling us how to make profits in a slow growth environment. Phil Strebel down in the pits of the CME. Phil, this is a pretty significant cluster this entire week of 100-plus point swings. And we had different headlines propelling this, but by the end of the day, you look and you see what a great week it's been for the bulls.
Yeah, I mean, what an amazing week. And, I think the thing with a jobs number, we all set these, expectations. And I think the reality is you got to look at the change from month over month. We're seeing a 50% increase from last month. I think because of that kind of movement up, I think it got a lot of optimism. We started seeing some of that emerging market problems. Those started to dissipate. And I think people are, getting a little bit more comfortable. The Fed, they may not, accelerate that tapering the way it was anticipated because of some of these uncertainties. But I think really, we do have a firm footing right now. I think that a lot of shorts came in, started covering the market. And I mean, look at the move. I mean, it's phenomenal.
It is phenomenal.
To the
Jeff,
upside.
it takes a strong man with a lot of nerves and steady hands to live through these shaky times. You have all those things, though. You're a very patient man. You've seen these ups and downs before in markets similar to this. You are a bull long term, but you still don't think we've hit rock bottom in terms of this pullback, do you?
Well, I think you had a rumor go around the trading desk yesterday that the number was going to be 300,000 on the non-farm and a 6.5%.
That was a whisper,
print.
yeah. It was wrong, dead wrong.
And, well, yeah, but it caused a lot of short cover, and you broke the market out above some key levels, caused some pile-on buying. I still think you get a peekaboo look above 1,800, and then I think they try to, whoever they are, I think they try to pull it back down and go through a bottoming process. But longer term, I think we're in a secular bull market that has years left to run.
Well, let's get to Tom Lydon. Perfect segue here because you're the ETF guy. Do you agree with that assessment? Secular bull run that's continuing after already maybe going on for several years at this point.
Well, it is, and it's been a great couple of days, as you point out, Liz, for the average investor who had that queasy feeling in their stomach over the last 4 weeks. We've seen some great trends as far as flows. Money came out over $10 billion in January out of equities, but much of that money went overseas into Europe. So Europe really is hot right now, and also it gave investors a great buying opportunity if they had money on the sidelines to get in, especially corporate bonds. Corporate bonds had a nice correction, so high yields and corporates have some great opportunities as well.
You believe that's an opportunity. What is the best way for an investor to play that then?
Yeah, a couple things. The PIMCO HYS 0 to 5 year duration. Short duration is key. And also the ProShares hedged treasury, which is also very, very important from a high yield standpoint. Bring that duration down to 0. HYHG. And then finally, as we talk about Europe, there's opportunities there too.
Phil Strebel, I don't mean to throw a fly in the ointment here, but we have oil now at triple digits once again. It just traded over $100 after the market closed, the NYMEX closed. But what are we going to think about this? I mean, there is a potential there. It's happened before. It's trading at, that's where it closed. It's actually after hours trading above $100. Is this going to continue? Because that can be a drag on the economy.
Yeah, it can be. And I mean, that's something we always talk about anytime we see triple digit. I mean, are they going to release from the Strategic Petroleum Reserve? Things like that they start discussing. The reality is I think that this type of movement is temporary. What's going on right now is you've got some of the refineries, they're shutting down for maintenance purposes. And with that, we've got such cold weather coming through. The heating oil demand is really high right now. Because of that, they use crude oil, they crack it into heat, and they crack it into gas. And you're seeing that heating oil premium continue to rise up. Gasoline prices are going to rise right in tandem. Same thing with crude oil right behind it. But I think once these refineries come back online, that's what you got to watch out for. And you got to watch out for when are we going to have some normalization and stabilization in the weather. Then it all starts to come back down.
Jeff Sott, what should investors be buying right now? It's a very tough market to anticipate.
Well, these kind of pullbacks for the well-prepared investor present opportunity. We, in essence, timed this. I've been on your show a number of times in January saying that the timing models called for a pullback starting in late January or early February, and, we're here. So I think in a low growth economy, which I think we're going to grow at about 3% this year and 4% next year, Wall Street will pay up for growth. And growth stocks tend to be clustered in tech and in healthcare. And those two sectors are trading more than one standard deviation below their historic median valuation. And in the terms of technology, it has a 22% return on equity versus the S&P's 15%.
And there we see two techs and two healthcare stocks on top of it. Tom Lydon, the S&P moving average, thankfully we're above the 200-day moving average right now. But what happens if we fall below that? Do we begin to cash out some of these stocks?
Well, I think naturally that's going to happen. But fortunately, as you point out, David, we missed it by 3%. So with the 2 or 3% move we've had of the last few days, we're 5% above, enough of a cushion. The big growth story is going to be overseas, though. Developed nations, especially Europe. The key is watch the currency, because the dollar will be rising. Currencies like the euro will be declining, and that can eat away at your appreciation.
So does that make you avoid certain countries, Tom?
Well, I think developed nations, especially I go to Europe right now, there's some specific ETFs that not only invest in those areas, but they'll hedge against the currency. So it'll translate into dollar terms. Very innovative. The great thing about the ETF business, it continues to provide great choices for investors and disciplines within their hedging strategies.
Tom Lydon, Jeff Sott, what a pleasure to have both of you on. Thank you so much. Have a terrific weekend.